Cost Accounting, Chapter 20. Chapter 20 closes out all of our chapters about performance evaluation and management compensation. So this talks more specifically about what comprises management compensation. So we pay a fixed payment. This is our salary. So this is the payment that we're under contract for. Then we might have a bonus based on achievement of any performance goals. And we've looked at in chapters 18 and 19 different ways to set performance goals that we would measure. And then we would also have benefits. So these can be called perks, and they cover anything from travel, tickets to events, having accessibility to a vehicle, anything that the customer or the firm pays for. If you have clothing that's applied to you, vacation, benefits, sick leave, insurance, and other things. When we're looking at management compensation, we need to make sure that we're writing compensation plans that help to make our strategy happen, and that we look at adjusting those plans as the strategic conditions of our company change. So whether we're new in the market or we're established in the market, or we have a manager of a product line that is getting ready to exit the market, and making sure that we fluctuate those compensation plans. There's, of course, a common concern that executive pay is currently too high when compared to that of lower level employees. So the textbook covers a couple of programs that were put into place. So one is the Frank-Dodd Act, and the Frank-Dodd Act requires companies, or the Dodd-Frank Act actually, requires companies to disclose the ratio of their company's salary with the median pay to the rest of the company's workforce. So this is to help in people who might be interested in investing in the company to make decisions about what they deem as the reasonableness of executive compensation. And the SEC also requires for executive plans to be disclosed by public companies. And they've adopted a rule that requires companies to have shareholder votes on executive pay. So looking at the kinds of different things that affect executive pay, and if you go back to the 2008 financial crisis, you can find a lot of information, articles, news stories, specifically about executive compensation. There was a lot of disagreement in the fact that many of these banks were given government bailout funds, and instead of helping their customers or helping their investors, they actually used those government bailout funds to provide bonuses to all of their executives. So there's a lot of controversy publicly around executive bonuses and management compensation. So the main reason for management compensation was discussed in chapter 18. So this is to motivate them to meet their goals and to give them an incentive to act with goal congruence. So to make decisions that are beneficial to the organization as a whole. There's a variety of different bonus plans and how we build those bonus plans. So first we talk about 3 different types of bonus plans. One is base of compensation. So this is how the bonus pay is actually determined. Then we have bonus compensation pools, which is the source of financing to pay bonuses. And then the different payment options. So how is the bonus to be awarded. So first, we're going to look at base of compensation. So bonus compensation can be determined on the basis of many things. There are some examples here. So stock price and changes in stock price, performance measures that we've talked about in various chapters, and then more that we're going to talk about in this chapter. So ROI, financial measures, growth, variance analysis, and then using performance measures as a balanced scorecard. Once our base is chosen, then the firm has to choose a method for calculating the amount of bonus based on those measurement goals. So we've talked about all of these different measurement goals, but then the firm has to choose bonus amounts by, okay, if there's a 3% growth, how does that affect a bonus versus if there's a 6 or 7% growth? And the bonus compensation pools. So they're either unit-based or firm-wide. So unit-based compensation pools come from the income of the actual division that the manager is in charge of. And a firm-wide pool has an amount of bonus available to all managers, and that bonus depends on the firm's performance as a whole and gets separated out among the company in different chunks. Payment options, we have a current bonus, cash or stock based on current performance. This is the most common form of a bonus payment. A deferred bonus is a bonus that we earned currently, but we're not going to receive for 2 more years. So deferred bonuses are usually happen for tax planning purposes. Because bonuses have a higher tax rate than normal income, we might want to find ways to defer the tax on that bonus or help us save for what that payment is going to be in that tax. Stock options give us the right to purchase stock at a future date, and performance shares give us stock for achieving any of those performance goals that we've been looking at. When we're tax planning, we have to think about some of the reasons that we have compensation plans. So compensation plans, the firm wants to reduce the taxes that both the firm and the manager have to pay. A lot of perks are deductible to the firm, but they're not considered income to the manager. But other perks are deductible by the firm and are also considered income to the manager. So choosing compensation plans that benefit both the firm and the manager, where the manager isn't required to pay a tax penalty for receiving a bonus or a perk. We have various different ways to analyze business units. So we've talked about those in several chapters throughout the book. We've talked about the balanced scorecard in multiple chapters, then ratios to measure performance. We've talked about several different ratios, and then we're going to also bring back financial ratio analysis as one of those ratios to talk about that we covered in Principles of Accounting 2. And some of you who have had business finance already have also covered those ratios. We also have the economic value added component that we talked about in chapter 19. The balanced scorecard is used to evaluate our firm. It can also be used to evaluate and compensate division managers. So we might say this particular manager is responsible for 2 of the items on a balanced scorecard, and seeing what their benchmark is and what the actual results are determines what their bonus is. So we have this example of a company that has their benchmark at 90% of the best performance in the industry. So we have their information here about what their current assets, long-lived assets, current sales, and current net income. When we look at the performance measures, they have 3 CFFs. These CSFs are also called KPIs in some other textbooks. So we have return on total assets, which covers financial performance, number of quality defects, internal processes, and number of training hours for plant workers, so learning and growth. So we have three of the four balance sheet components are covered in our CSFs. So when we're looking at these, the financial report performance or return on total assets, they're looking for a 22% target. Well, they actually exceeded their return on total assets. What they did not exceed were the quality defects target and the training hours target. So comparing their target goals to their actual performance goals. Another measurement we have is financial ratio analysis. So we generally use the liquidity and profitability ratios. So key liquidity ratios are accounts receivable and inventory turnover, current ratio, quick ratio, and the cash flow ratios for operating cash flows and free cash flow. So the accounts receivable turnover is average accounts sales, credit sales, divided by average accounts receivable. And inventory turnover looks at cost of goods sold and compared to our inventory and accounts payable. And the current ratio is current assets to current liabilities. The quick ratio is quick assets, which are cash, accounts receivables, and cash equivalents, to current liabilities. And our key profitability ratios are the gross margin percent, return on assets, return on equity, and our earnings per share. So now we see that same company and what their benchmark is for their ratio goals compared to their actual goals and whether they met or did not meet those particular goals. So of the things that they are measured about for their performance evaluation, 2 of them were unmet. Economic value added, or EVA, we talked about this extensively in chapter 19 and the calculations for it. So we have to make adjustments to financial accounting data to take care of those accounting distortions that come from various things like inventory, costing selection, full costing, depreciation types. So we have this very easy example here where we're looking at the EVA with invested capital, looking at total assets less current liabilities. So EVA, net income minus the cost of capital times invested capital. So the net income plus training and interest expenses after tax minus 0.06 times the average total assets plus training expenses. So these are the adjustments that we make to the accounting information to come to an economic value added amount. So we have training expenses are added to total assets and to net income for these calculations since they're considered as an investment in our company for the purpose of this calculation. We also have business valuation. So business valuation looks at a company's value or worth from the viewpoint of the shareholder and the viewpoint of a potential buyer. We have different methods to measure the value of shareholders' equity. So this is part of the business valuation. So we can look at the book value method. So what is the value that appears on the balance sheet for stockholders' equity? What is the market value method? So the current market value of the firm's shares compared to their common equity. The discounted cash flow method, which measures the firm's equity value as the discounted present value of estimated future cash flows, and the multiples-based approach, which uses ratio of stock price to a financial measure to determine the value of the firm's equity. So we're going to talk about a couple of these methods. First, the discounted cash flows method. So when we're using the discounted cash flows method, we are going to forecast future free cash flows for a 5 to 10 year period. Then we're going to forecast the free cash flows beyond that horizon using some kind of an assumption. So, for example, that cash flows will happen consistently for the life of the organization. We discount those free cash flows using the weighted average cost of capital, and then calculate the value of equity by adding those values calculated in step 3 to current non-operating investments, and then subtracting the market value of our long-term debt. The types of multiples that we use for valuations based on the ratio of stock price to a key financial measure are looking at stock price as it relates to our earnings, to sales, and to cash flows. And then the last valuation we look at is their enterprise value. So enterprise value is the measure of what a company is worth as an acquisition. So this is the market value of our equity plus debt and less cash. So this is used by investors and shareholders to determine the valuation of a company if they're considering buying it or making a purchase. Well, of course, in class next week, in our examples, go through some actual examples of calculating these measures that have been talked about in chapter 20. This is the end of chapter 20, and chapter 20 is the last chapter in this textbook, and that will be covered for this semester.